Darius Dale, it's good to talk to you, and I'm looking forward to this as a follow-on to Keith McCullough's conversation with Raul, which was about 4 months ago. I mean, that was the first time that we had Hedgeye on, and we were talking about your 4-quadrant model.
Yeah.
And I wanted to piggyback on that. I know that Keith was talking about Q3, quad 3 rather, for both this quarter and next quarter. First of all, tell me, what does that mean, and how have things changed since then?
Yeah, absolutely. I appreciate you being here, there. Thank you for having me, Ed. So quad 3 is an economic regime that we're seeing in the U.S. here currently, and expect to continue, really persist through the beginning part of next year. And what I mean by quad 3 is that growth is decelerating as inflation's bottoming and starting to reaccelerate. Historically, that's been sort of characterized by late cycle economic dynamics, and there's a whole host of sort of asset allocations and portfolio construction pivots that investors need to be aware of as we sort of dig deeper into quad 3.
And tell me, in quad 3, what sort of asset allocation strategy, not just in terms of equity versus bonds, but also sector allocation, stylistic plays, et cetera, do you think are appropriate at this particular juncture?
Yeah, so I think you can sort of rewind the tapes a little bit. You can go back into the latter part of last year, quad 4. In Q4, quad 4 is when both growth and inflation are slowing concurrently. Historically, that's been a really, really negative environment for risk assets. You tend to see credit spreads widening. You tend to see the more cyclical components and the more growthy components of the equity markets lead to the downside. And that's precisely what we got, obviously, heading into those December 24th lows. And you sort of back up the tape. Okay, what happens when you transition out of quad 4 into quad 3? Well, kind of the two biggest pivots to make are, one, energy goes from a top 3 short to a top 3 long. Crude oil and energy-related equities tend to do fairly positively in quad 3, and more importantly, tech, growth, and high beta as style factors tend to do quite well in quad 3, particularly large cap, growth-oriented securities. As markets and investors start to pay an increasing premium for those kinds of factors as you start to lose the more cyclically oriented companies from a performance perspective.
And what about the equity versus the bond part of the portfolio? Do you see bonds underperforming versus equities there as a result?
Well, so I think you kind of have to make the distinction. So if I mentioned this earlier, quad 3 has historically been sort of much more associated with the more late cycle dynamics, and I think it's important to sort of kind of parse out the different styles of quad 3. There's sort of two types of quad 3. One, it's the quad 3s at the end of the cycle that tend to lead into quad 4, i.e. recession. That's sort of 2001, that's sort of 1990, that's obviously 2008. And then there's the sort of more run-of-the-mill kind of late cycle, but not quite there yet on recession type quad 3s. And that's 2000, that's 2011, that's 15 into 16, and that's something we currently see is today. So what you tend to see, the asset performance with respect to, and I'll get back to your question sort of full circle, the performance of the market in a non-recessionary quad 3 environment, particularly when it lasts multiple quarters, is typically flat. If you look at it from an index perspective, i.e. the S&P 500. But when you break open the atom underneath the hood and you look at the sectors, the industries, and the style factors that sort of comprise the equity market, typically what you happen over these sort of multi-quarter quad 3 episodes, non-recessionary episodes, is that about half the style factors are up about 10 to 15% on average, and about half are down about 10 to 15% on average. So it becomes this fantastic environment for sort of fundamentally oriented investors to find themselves in the right securities and in the right sectors and the right style factors to generate alpha. So if you think about, so if going back to, you mentioned our GIP model, the framework starts with, quad 1, that's growth accelerating as inflation decelerating. That's a really, really positive for risk, really positive environment for risk, rather. Everything tends to go up a lot in quad 1 from an equity and credit perspective. Quad 2, everything tends to go up, maybe not as much as quad 1, but it's all going up. Quad 2 is where growth and inflation are accelerating at the same time. I mentioned quad 4 is really negative when growth and inflation are decelerating at the same time. That's a really negative environment. Quad 3 is this kind of environment where half the things do well and half the things do really poorly. And so that creates this fantastic environment, sort of for alpha generators who sort of kick and scream when they can't make money on the shorts because everything's going up in quads 1 or 2, and then they get blown up on their long book, when everything goes down in quad 4. Quad 3 is this perfect sweet spot for investors that we think more fundamentally investors are really going to appreciate as the year progresses.
It's interesting because, first of all, I was thinking about the time frame, but you said something about the next 2 or 3 quarters, quad 3. So it sounds to me like you're basically making a call that there's going to be no recession. That we got rid of that risk in Q1, and as we head to the rest of 2019, it's not going to happen.
Yeah, so I think it's important to sort of contextualize. Yeah, we do not see a recession on the horizon with respect to our forecast. Our forecasting tools have sort of visibility up to a next 12-month time horizon, and at no point of that time horizon do we see a recession occurring from an economic perspective. One thing we do see very much risk of, and this is something we can sort of unpack the atom on as well, we do think there's risk of a corporate recession here in the United States. If you look at how the S&P companies have reported, or really just U.S. corporations have reported in Q1 thus far, Q1 to date, they're sort of narrowly staved off dipping into annualized contraction on earnings. Obviously, sales are slowing and earnings have slowed again. But again, they're better than expected, and more importantly, they're positive. We don't think that's likely to be the case in Q2 and Q3 as they start to lap up against the cycle peak comparative base effects for earnings and for sales and earnings. Q2 and Q3 are the mother of all comps. If you have to go back to sort of Q2 and Q3 of 2000 to sort of see sort of base effects this stringent and this difficult that we do see in the current quarter. And if you go back to 2001, what happened in 2001? Well, 4 quarters later, when you start to lap those comps, with many of the same conditions that we have today, i.e., an annualized dollar appreciation of 5 to 7%. You have the rest of the world kind of not doing so great. And then obviously you have a tight U.S. labor market, which we can sort of dovetail into after this. Those 3 factors, sort of coupled with those comps, produce, earnings on the order of down 15, 18% in a heartbeat for S&P 500 companies. So we would argue that was sort of the death knell for the equity market then. That was the death knell for credit. If you remember, credit spreads blew out and stayed wide throughout that entire time frame, from the market peak in 2000 to the lows of 2002. And that's a risk. We don't necessarily see a multi-year bear market as a base case scenario in the absence of a recession, but we definitely think that's a risk to a lot of those companies and sectors and style factors that aren't going to be able to show the sales and earnings growth that they need.
So we talked a little bit about style factors in terms of large cap. I think you were saying large cap growth. You would favor that. What do you favor in terms of sectors of the economy based upon this Q3, this quadrant 3 multi-quarter?
Yeah. So just I'll sort of take it down one by one. So from an index perspective, we definitely think large cap growth, small cap value is the best alpha generation trade out there. That's according to the back test. That's according to all the individual types of securities that comprise those particular indices. With respect to tech, NASDAQ 100 being sort of dominated by sort of tech, and the Russell value being dominated by financials. With respect to the sectors, tech, energy, utilities, and REITs are the longs historically in quad 3, whereas financials, materials, and consumer staples tend to be the shorts. If you think about the things that why are these shorts, right? Real interest rates are declining in quad 3. So obviously that takes out the financials. Labor costs are rising. Late cycle, that obviously takes out the consumer staples, and then raw materials prices are rising for the materials companies. If you think about these sort of more industrial oriented materials companies, you got energy up 30, 31, 32% year to date. That's something that's obviously going to sort of feed into their P&Ls, and you're seeing the underperformance of these particular sectors thus far in the year to date, and that's something we think is likely to continue and actually start to diverge. So if one of the things we're not one of these sort of Nostradamus type firms, and everything we've ever said and every sort of trade recommendation we've ever made is live on our website. Anyone can download all of our history going back to 2008 on every trade we've ever made. And one of the things we got wrong in 2019 was that the U.S. economy was in quad 1 and Q1.
Right.
I think a lot of investors ultimately got that wrong. If you think about the all-time high net short position that built up in S&P 500 futures and options by late February. You can debate the merits of that growth number with inventories and net exports accounting for over half the growth, which is an 88th percentile reading in terms of those two weighted contributions to growth. You look at the PCE deflator was understated. The PCE deflator understated actual consumer price inflation by 170 basis points. That understatement in terms of its contribution to the headline growth rate was also in the 88th percentile. So we're talking a very cockamamie report, but the data is what it is, right? So,
and how much of that was policy driven versus the internals of the market and the flow of the economy? I mean, to the degree that we had a massive reversal in terms of monetary policy.
As big as a reversal we've probably ever seen. So with the Fed, as recently as mid-December, was hiking rates and saying we're tightening and we're far from neutral. As soon as January, and obviously again in January, twice in January, and then again in March, the Federal Reserve basically opened up the door for rate cuts. We call them PE POW, short for private equity POW. Obviously, the guy has a history in private equity, but if you think about who's got his cell phone number down there in D.C., it's David Rubenstein, the head of the Washington Economics Club.
Carlisle.
It's Carlisle, David Rubenstein of Carlisle, Keith's former employer, actually. So I probably might get in trouble for saying that. But anyway, no, the point I'm making is that the Federal Reserve is not here to promote full employment and price stability. Mm-hmm. The Federal Reserve is here to make sure credit spreads don't blow out. So it's consistent with our view of an earnings recession that could perpetuate a widening of credit spreads, that the Federal Reserve is likely to get incrementally dovish from here, if we're right on that particular sort of facet of the thesis.
Tell me a little bit about this earnings recession and how firms will deal with that going into the end of the year.
Well, it's interesting, right? I mean, you're saying how corporations are likely to deal with it?
Right. I'm thinking share buybacks. Are they throwing the kitchen sink at
that? So that was Q1.
Right.
That was Q1. I mean, they threw the kitchen sink at Q1. And this is the beauty of the calendar as well. The calendar is a factor. Time is a factor in all time series. You think about what they can do in Q1. They can throw the kitchen sink at it, make it look good, and oh, by the way, we have a whole year to basically, sort of in terms of communicating to investors that things will get better from here. Things definitely are going to get better. My guidance, I'm going to maintain my guidance. Things are not so bad. As you get into Q2, obviously reported in July, you can get into Q3 reporting in October. They won't have the full year as relates to the calendar, and the markets won't have. The markets won't necessarily be inclined to believe these CFOs who obviously didn't see a lot of this stuff coming. If you go back to Q3 of last year, they obviously didn't see Q4 of 18 coming. If they could have all told you that growth was going to get cut in half and then get cut in half again, from the perspective of sales and earnings, they would have told you that. But obviously they didn't. So I think there's a lot of sort of surprisers with respect to where credit spreads are. Basically 350 basis points over on high yield. Sort of baked into the cake. If these numbers don't come in better than expected and more importantly positive, we definitely think that's going to be the sort of next shoe to drop with respect to domestic asset markets.
Interesting. So how far out are you willing to go in terms of your thinking about the macro? Are you going to go into 2020, or is it sort of a 2019 play in terms of where you have visibility?
Yeah, so the 2 quarters that we expect to see the most sort of negative earnings growth are Q2 and Q3 of 19. Once you get past Q3, the comps really start to sort of recede sharply, and it's unlikely that growth will get more negative from there. The one thing I'll caveat that by saying is that the labor market continues to be impressively tight. So one of the metrics, the key metric we track to determine how tight the labor market are, there's a few, but the most important one is the spread between the U6 underemployment rate and the U3 headline employment rate. Historically, when the spread is about as tight as it is now, which is roughly there about 350 basis points wide, you tend to see all of the peak rates of average hourly earnings growth in any given cycle, north of 3.5%, 4%. So we expect that to be, we expect 3.5%, 4% average hourly earnings growth on a trending basis from now really throughout the cycle, because wage growth tends to peak during recession, actually. It's actually one of the things that causes recession. So if you think about just running a business, your sales and earnings are slowing, but your labor costs are rising. What do you have to do to sort of ameliorate that? You have to start, at the bare minimum, you got to, reduce hours worked, reduce sort of wages, but you really can't cut wages, right? So what tends to happen as a function of that, you start to see declines in total employment. So we're not there yet. I think it's that sort of, we kind of gotten too far over our skis with respect to that view, but we definitely think a lot of the sort of sectors, style factors, particularly, small cap value, financials, materials, consumer staples, a lot of these companies are sort of at hostage to that. And they're, by the way, they're also hostage to just historically being underperformers in Quad 3. These are the sector style factors that investors have historically shunned in Quad 3. So you kind of have this double whammy where you can make a lot of money from a macro perspective. You can generate a lot of alpha just from a top-down perspective. Right. I'm just sort of thinking about having this Quad 3 playbook on.
I know we're running out of time and so forth, but because I have a ton of different questions.
Yeah,
I saw a note that you put out where you were talking about volatility clustering. And I wanted to figure out what do you think that means in terms of where we are in this process that you're talking about?
The note I was citing was sort of this volatility clustering in Chinese equities and energy-related assets of late. Where that sort of framework comes from Professor Mandelbrot over at Yale, a former Professor Mandelbrot at Yale. He's effectively talking about it's hard to predict the directional price change, but it's easy. It's sort of volatility is sort of autocorrelating in the sense that small price changes tend to lead to small price changes, large price changes tend to lead to larger price changes. And typically what the reason for that is because the fundamental reasons for why asset and macro markets trend in any direction, i.e. growth or inflation or policy trending in a direction, those things tend to be glacial. And those things tend to sort of drag volatility profiles of particular securities or assets in one direction or another. So you're the most important thing you can do as an investor, when it comes to you're sort of at a new regime in volatility, or at least you see a clustering of volatility that's different from where volatility is previously trended. You have to ask yourself, are you entering a new regime?
Right.
So it's the most important sort of thing. And with respect to energy specifically, is in Quad 4, energy is a top 3 short. You want to be short as much crude oil and energy-related equity exposure as you possibly can. In Quad 3, it's one of the best places to be on the long side. So, if you sort of take into consideration our forecast for inflation to sort of rise modestly over the next couple of quarters and then sort of hockey stick in Q4 and Q1 of next year, we're kind of in this weird place right now where the market is debating Quad 3 versus Quad 4. Right. I don't think the market is debating Quad 1 versus Quad 2 versus Quad 3 or Quad 1 versus Quad 3. It's more likely the market is debating Quad 3 versus Quad 4. We ultimately think Quad 3 is likely to win, otherwise we wouldn't have this sort of asset allocation view.
But that's where the volatility is coming from because of that debate.
Exactly. So you have to have an accurate forecast on what the next regime is going to be. I think right now it's what regime we're in is ambiguous with respect to the broad preponderance of market participants. Is it Quad 3, is it Quad 4, is it Quad 2, is it Quad 1? I think by the time we dig deeper and deeper into the year, it's going to be increasingly likely that we're in Quad 3 from a reported data perspective, but also more importantly from a market perspective. One of the things we hadn't hit on yet, I would like to sort of introduce is our view on the dollar. So we've been very positive on the dollar really since April of last year when we saw the global economy trending towards Quad 4. Historically, the dollar has been a very, very sort of strong asset, safe haven asset in Quad 4 when both the U.S. and the global economy are Quad 4. You start to sort of look in the second half of 2019, it's very likely that the global economy, particularly Europe and China and a lot of sort of related emerging markets, are trending in Quads 2 and Quads 1. Historically, when the global economy is trending in Quads 2 and Quads 1, the dollar gets hammered. So at some point in the next sort of 6 to 9 months, you should expect to see a series of lower lows or lower highs with respect to the U.S. dollar. You should start to see the euro bottom and start to trend higher, make a series of higher lows from there. And this is all in the context of a very consensus net short bias in the euro. You see in risk reversals as well. So the market is sort of setting itself up to sort of have this massive sort of down dollar reflation moment if we're right on all these different facets. And I mean by the corporate profit recession causing the Fed to get incrementally dovish. You're talking about a European and Chinese economic recovery that sort of resuscitates the global economy. If those two things happen, the dollar is going to get absolutely hammered in the back half of the year. And we think on the back half of that, or at least on the other side of that trade, is obviously reflation and commodities. So that's one of the ways in which we think you can win here. So we're kind of long-term energy bulls here, and by long-term we mean 6 to 9 to 12 months as it relates to this view. But we definitely we're definitely there.
We'll leave it there because I think that that's a good place for us to think about when we're going to come back and talk to you guys about say the back half of this year, how that plays out and what you see for 2020. So really appreciate your sharing the time with us and look forward to seeing you in a few months.
Cool, absolutely. Thanks, Ed.
So Darius's investment view is based on Hedgeye's proprietary macro risk model that identifies 4 quadrants of growth and inflation. His view is that for the next couple of quarters, the U.S. is in and will remain in Quad 3, an environment of slowing growth but rising inflation. Darius makes several stylistic and sector recommendations based upon this. First, he recommends an overweight position in large cap growth paired with an underweight in small cap value. From a sector perspective, he recommends going long energy and short materials, long utilities and short financials, long REIT and short consumer staples. At the same time, Darius sees global growth accelerating, defined in Hedgeye's macro model as sectors 1 and 2. China and Europe will lead the way in his view. So Darius says that is bearish for the US dollar and bullish for the euro.